VIX is one of the most important indices to follow for option traders. It represents the level of fear in the marketplace as reflected in the prices of SPX options and measures the expected market volatility over the next 30 days. In this lesson, we'll go into the details of how the VIX is calculated so that we understand the intricacies of the VIX as compared to VIX products such as VIX Futures, Options, and ETPs. We'll also look at the cash settlement process for VIX Futures and Options and the similarities and differences between this special settlement value, which is available only on expiration day at market open, and regular VIX. In this lesson, we're going to talk about VIX calculation and also the cash settlement process for VIX Futures and VIX Options. We're going to start by thinking about what VIX is. We all know what VIX is. We know that typically when the market goes down, VIX goes up, and when the market is steadily going higher, VIX tends to go down or stay steady. But what exactly is VIX? VIX is a number that's reported widely alongside the main indices such as the S&P 500, the NASDAQ 100, the Dow Jones Industrial Average. So it's a very important number. But what is it? What exactly is it measuring? Well, the VIX index is an index that represents the expected volatility over the next 30 days in the stock market, represented by the S&P 500 index, in this case the SPX. So we're going to use SPX to derive a value for VIX. But we're not going to use SPX directly. We're going to use SPX options. And let's talk about SPX options a little bit. As we know, there's plenty of expirations for SPX options. In the past, there used to be only one. There used to be only on the third Friday of each month, you would have SPX options expiring. Nowadays, you have those, and those are called standard SPX options. But we also have weekly SPX options. The expirations that were added were the expirations on a Friday that were not the third Friday of each month, and also expirations were added for Mondays and for Wednesdays. So nowadays we have every week, we have SPX options expiring on Mondays, on Wednesdays, and on Fridays every week. Now, one of those Fridays every month is going to be the standard expiration, but the rest can be traded as well, and they're exactly the same. Well, not exactly the same, because we're going to talk about the nuances and the differences between standard expirations and weekly expirations. But for the most part, you can say that you have SPX options every Monday, Wednesday, and Friday of the week. I'm not even going to talk about the monthly or the quarterly expirations for SPX options. We're going to stick to weeklies and also standard. Okay. So now VIX products, in this case, VIX Futures and VIX Options, don't expire on Fridays. They expire on Wednesdays. Why is that? Well, VIX is an index that's measuring the expected volatility over the next 30 days. So if we have a product that expires 30 days before an SPX option expiration, then we're going to have a very precise measurement of the expected volatility for that period. This is why VIX products expire on Wednesdays, not on Friday, because it's exactly 30 days before a Friday, so that we can use those options to calculate the settlement value for the VIX. But I'm getting ahead of myself. So far we've seen that VIX uses SPX options. There's many types of options, many types of SPX options, Monday, Wednesday, Friday. Wednesdays, we have VIX products expiring, so VIX Futures and VIX Options. And VIX also has weekly VIX Futures and Options, and also standard VIX Futures and Options. And as you may guess, the standard VIX Futures and Options are the ones that are pointing, so that are expiring 30 days before a standard SPX option expiration. So we're going to have on Wednesdays, every Wednesday we're going to have an expiration, but some of them are going to be weekly and some of them are going to be standard. Okay, so VIX Futures and VIX Options expire and are settled to cash on Wednesdays. So all VIX Futures and all VIX Options expire to cash. So they're settled to cash so that you don't have to take delivery of anything. So this is one of the reasons why traders like to use VIX products, because you never have to take delivery of any underlying. So it makes the trading of these products very, very clean, not messy at all, because you can never be assigned. You don't have to exercise. You don't have to do anything. You keep the product, it expires, and it settles to cash. So it's very clean, and it's a very good way to trade volatility. And the most direct way, the most straightforward way to place bets on volatility as an asset class. So in this case, as we mentioned, we have SPX options every week. We have 3, Monday, Wednesday, Friday. And then we have some that are standard, some that are weekly. So we're going to go through an analysis. We're going to go through an example. So we're going to start seeing which options are used for the calculation of VIX. Okay, so we're not going to actually use the formula. It's an algorithm that's quite involved, and it's a formula that you can get from the VIX white paper put out by the SIBO. But in this case, we just want to understand where those values are coming from, not necessarily how to do it ourselves. But basically, what VIX does is it takes 2 sets of options, and it gets it uses all the different options. In this case, we're going to see later on that it's going to be the out of the money options to calculate a value of volatility for those 2 expirations, and then using interpolation, you can arrive at a 30-day constant volatility value. So it's always measuring what the expectation of the market is for volatility over the next 30 days. So in this case, what we're going to do is we're going to, as I mentioned, we're going to go through an example. We're going to assume that we are on October 12, 2020. Okay. So on October 12, which was a Monday, you're going to have all the different SPX expirations, 12, 14, 16. Now 16 in yellow is a standard SPX expiration. The next standard SPX expiration is the 3rd Friday of the next month, which would be November. This is the first one, second one, third one. So November 20th is the next SPX standard expiration. So SPX option in their standard expiration. Okay, now 30 days before the standard expiration of SPX option, we're going to have a standard expiration of VIX products. This is why I have this one in all blue, not only the W, but all blue, because this one is going to be 30 days before the standard expiration of SPX options for November. So you can see why this is so important and why this is done on Wednesdays is because at that point you have exactly 30 days, and it's a good point to settle those products to cash and to do some other things in terms of rolling futures, options, etc. We're going to talk about those procedures later on. But this is why we have the same way we have for SPX standard and weekly expirations. We also have for VIX standard and weekly expirations. And most of the volume for VIX futures and options goes to via standard expirations, even though there are weekly expirations for futures and options. So whenever possible, it is suggested that you go into standard VIX futures and standard VIX options. So when we start on October 12th, we can get the days to expiration. So on the 12th is 0, 2, 4, 7, 9, 11, etc. So we have several. So these are all the different SPX options and the number of days to expiration that you have for these particular expirations. VIX uses out-of-the-money SPX options expiring on Fridays, weekly or standard expirations with more than 23 and less than 37 days to expiration. So this is important. We have Monday, Wednesday, and Friday SPX options. Mondays and Wednesdays expirations are not used by VIX. So we're not going to look at those. We're only going to look at Fridays, and we're going to look at both standard and weekly expirations. So you can be, and it's going to have 23 and 37, more than 23 and less than 37 days. So they're going to be consecutive weeks. So they're going to be 1 week apart. So to calculate the VIX, VIX is going to use 2 expirations, and then it's going to get the volatility for each, and then via interpolation, it's going to get the number for 30 days. How? By weighting the different expirations and getting what would be the volatility for the next 30 days. So in this case, VIX would be calculated by using the options on November 6th. Remember, we are on October 12th. So the current VIX is going to be calculated by using November 6th, so 25 days to expiration, and then November 13th, 32 days to expiration. As you can see, here it's using 2 weekly expirations. So you can use weekly or standard, or 1 weekly and 1 standard. Now, so far we know that it uses out-of-the-money SPX options expiring on Fridays with more than 23 and less than 37 days to expiration. We don't know any more than that, and we're going to go into the details a little bit later on. Now, as a comment here, exchange traded products such as VXX and UVXY use futures to replicate the behavior of VIX. So what they do is they use future contracts. Okay, so as you can see, there's weekly futures contracts for VIX futures, and there's also standard VIX futures. So in this case, it's important to know that these products only use standard futures contracts. So in this case, it will use the two upcoming futures contracts, and it's going these funds. What they do is they adjust the weighting of the number of contracts that they hold to produce a constant 30 days, or try to replicate the equivalent of a product that mimics the VIX in terms of being 30 days, the volatility for the next 30 days. Now, of course, in the past, we've talked about contango and backwardation. So I'm just going to mention this, that as time passes, for example, it's going to be using this one on the October 21st, and then this one on November 18th, 9 and 37 days to go. Now, after 1 day, you're going to have 8 and 36. So you're going to have to get rid of some of the contracts here and then start weighting this one a little bit more. So you're going to be selling this one daily and buying more of this one. So once you do this, what you're going to have is you're going to have you're going to have the impact of the relative values of the different futures contracts. So if these two contracts are in contango, meaning that the back month is higher than the front month, then you're going to be selling cheap and buying expensive contracts. In this case, this is going to act as a drag on the actual ETPs, on the actual ETFs or ETNs. If you have backwardation the way we have now, keep in mind, I'm talking about a few days before the US election. So we are in a term structure of volatility that's backwardation. So this one is higher than this one. Okay, of course, the when you sell something expensive and buy something cheap, this is going to be a tailwind for our fund. So this is going to be good. This is going to generate better results. Okay, so just as a comment, exchange traded products, ETFs and ETNs, they use futures, and they use futures that are standard expirations. They don't use any weekly expirations. Now we're going to simulate the passage of time. So now we're going to go to the 13th, and you can see that instead of 25 and 32, now we have 24 and 31. So VIX is continuously calculating the value for the expected volatility over the next 30 days. So the VIX value, this is calculated by the CBOE, and they are distributing this value all the time, during trading hours at least. Now, as you can see here, one of the things I did here is I grayed out these contracts because they're in the past now. Now it's October 13th. Now, we're going to be going to October 14th, and that's an expiration date for VIX products. Okay, so what's going to happen is these products are going to expire. Now, those are every VIX future and option. All of them are AM cash settled, which means that the last day to trade them is on the Tuesday. On the Wednesday, as the market opens, they get their settlement value, and that's what they're cash settled to. So what's going to happen here is, now it's October 14th at market open, 9:30 a.m. Eastern time. So now what's going to happen is, this is the expiration, this is where we are. These products are going to expire, futures and options. So we need to get the value that they're going to be cash settled against. They're not going to be settled against VIX. They're going to be settled against a special settlement value. So now, one of the things we notice here is that we have 30 days exactly. If we compare the Wednesday where we are with the November 13th expiration. Now, here, the algorithm to calculate the settlement value already considers this, but it's important to keep in mind that because this is a weekly SPX option, these ones expire at 4 p.m. and we're talking about market open. So in other words, these options have exactly 30 days plus the rest of the trading day, because they close at 4 p.m. Eastern time. So the algorithm already does this, but it's important to keep in mind. Standard SPX options, so on the November 20th, the third Friday of each month, those ones expire at the open in a very similar way to how VIX products are settled. So weekly VIX futures and VIX options are going to be settled to the value that's going to be calculated at the market open. This is called VRO, and it's a special opening quotation. It's similar to VIX, but it's also different than VIX. So VIX is calculated using two different sets of options, so two different expirations. VRO only uses one, okay? Because we're right 30 days out, okay? So it only uses these ones, and it doesn't need to interpolate anything because we're only using one, and it doesn't use the mid price of the bid and the ask for those options. It actually waits until the market opens and uses the actual trade prices. So when the market opens, those options are going to have a price that they're traded at. That's the number that the VRO is going to use to calculate the value for the settlement. There are quite a few differences between VRO and VIX, and we're going to go through them later on. But basically, they're very similar, but slightly different. In this case, VRO, market opens, it gets a number, and that's it. It's a static number. That's the cash settlement. That's the settlement value that all the futures and options are going to be cash settled to. So if you have a future and you bought it cheaper and it expired, and you were long and it expired at a higher price, then you made money, you get your cash. If it's the opposite, you pay your cash. So it's always cash settled, no delivery, no exercise, no assignment, no nothing. Same with options. VIX options that are expiring today are settled to VRO. So this number is very important because this is the number that everything is going to be cash settled to. Now, right after this number is obtained, we have the rest of the day, and on the rest of the day, still October 14th, but it's no longer active because you can't buy it or trade it anymore. Then VRO, it's a snapshot. It's only once a day, and then you move on, and then you continue with VIX. And VIX uses 2 different expirations, so it uses the rest of the day 2 different expirations. That's why the VRO value at market open, it's not going to be the same as the value of the VIX during that day. To start with, because VIX is going to be fluctuating during the day. And VRO, it's only a snapshot. It's only it's a value that's calculated only once on expiration day. Okay? So now you have VIX, and on the October 14th, next day happens, October 15th, and now if you pay attention here, we're going to be using the same expirations, but now we have, instead of 30 and 37, now we're going to be using 29 and 36 because it's the next day. Okay, so I'm going back. We used to have 30 and 37. Now next day, 15th, 29 and 36, and so on and so forth. So as time passes, you're always, the algorithm is always asking whether it's more than 23 and less than 37 days, and it uses those 2 to get those values, to get those calculations, and then interpolate them and get a single VIX number that's disseminated every 15 seconds, I believe. So first big thing that we need to understand here is that VIX futures and VIX options are settled to VRO, which is a number that's obtained at market open of expiration day. On expiration day, you cannot trade your futures or your options. You only have until the Tuesday before that Wednesday. Okay, once you didn't get rid of your options or futures on the Tuesday, then on the Wednesday, you're gonna have to be settled to cash, and you are settled to cash by using VRO. This is a number that's available on Wednesday morning, I believe around between 10 and 11 a.m. So it's a number that you can look up quite easily. Okay, so now we're on the 15th. This is 1 day to go. This is a standard expiration, but we're looking at VIX products. We just continue. Now we're going to jump ahead, and we're going to go to October 20th, so to the Tuesday. Now what's happening here is that we're approaching a standard VIX expiration. Okay, VIX futures and VIX options are going to have their standard expiration. So on October 21st at market open, the same thing is going to happen that happened for the weekly VIX futures and VIX options expiration. So we're going to have to get the settlement value, and it's the same thing. It's only going to be a standard one. So standard expirations for futures and options, for VIX futures and options, have much more volume, many more contracts. So they're a little bit more important, and a lot of money is moved based on the settlement value for that. So once we get to the 21st, so on the 20th, which is the Tuesday, you're gonna have to close or trade or whatever it is that you want to do if you have futures or options. If you get to the 21st, which is the Wednesday, you can't do anything anymore. You get to the 21st at market open. Now, this is a standard VIX futures and standard VIX options expiration. Okay, right there. And now you have 30 days exactly. This one expires in the morning. This one also expires in the morning because it's a standard SPX option. Okay, so the VIX futures and the VIX options expire right at the open. Same with the SPX options that are standard. So the third Friday of each month. So you have exactly 30 days. This is transparent to you. You don't need to worry about this. It's just nice to know or nice to understand. It's exactly 30 days. The algorithm already considers this. So now we have standard futures, VIX futures and VIX options that are going to expire. Okay, and they're going to use same thing, a VRO special opening quotation. The market's going to open. It's going to use the SPX options, out of the money SPX options, their actual traded price, not the mid price of the bid and the ask. We're going to go into more detail a little bit later, but it's important to understand here that it's a traded price. It's the price that the transaction happened at. So it's in that way, it's a little bit different than the VIX, because the VIX is the mid price of the bid and the ask of those different options, because it's constantly obtaining a value for VIX. It's constantly computing a value for VIX. So you can't wait to have an actual transaction. So it takes the bid and the ask and gets the mid price. Okay. Not for VRO. Expiration Wednesdays here, 9:30, get the VRO, a snapshot, you get the value, and then same thing happens. The VRO is only going to use one single expiration because we're exactly 30 days away. So you can get the volatility for 30 days if you have an expiration with 30 days. So it only uses one based on trade price, and you get the VRO. Now, after you get the VRO, that's the number that these futures and these options are going to be settled to. Now, once that happens, the rest of the day, remember, we're still on the 21st of October, which was the Wednesday, okay? You have VIX here. No longer VRO. Now you have VIX, but VIX uses 2. So now you're going to have, if you want to get strict, you have less than 37 days because it's 37 and the day is already underway. So you're going to use this one, which we just used to calculate VRO, but we're going to add in this case, a new expiration to calculate the value of VIX. Okay, so this VIX on Wednesday, on expiration day, this is going to be the same as on Tuesday, Thursday, Friday, etc. It's only the VRO that happens only on Wednesdays. And when you have the standard futures and the standard options expiring, that's the one that's a little bit different just because of the volume, because it has a lot more volume than the weeklies. And remember, ETFs, for example, alone, ETFs and ETNs use the standard expirations for futures exclusively. They don't use weeklies at all. So that's why the best liquidity and most of the volume is concentrated there. So that's why standard expirations are important. Also, if you think about it, once the standard expiration drops off, so once it's no longer available, on this day, the ETFs and ETNs are going to start pointing instead of to this one and this one. Now, this one's no longer going to be the near term. This one's going to be the near term. And then the next one is going to be the next term. And those are going to be interpolated to get the value that we want for VXX, UVXY, SVXY, and whatever ETP you want for VIX. Okay, so this is the Wednesday, the rest of the day. Typical, easy to understand, same VIX. Now next day, now you no longer have the this one available because it expired. Now on the 20th, on October 22nd, and you calculate VIX the same way you did. Now instead of 30 and 37, now you have 29 and 36, and so on. And so on so the cycle continues, etc. Now, we haven't talked about we know which options are used. We know that they're out of the money SPX options. We don't know exactly how the VIX is calculated, but we're not going to need to know. Let's just say that the same way that a variance swap is calculated is the way that is used to calculate the variance embedded in these options. And once you have that, once you have the variance via a variance swap, you can calculate a volatility. Volatility is the square root of the variance. And then once you have these two volatilities, you do the interpolation, and then you get the constant 30-day measurement of volatility, which is the VIX. Okay, so just to summarize what we've seen so far, VIX is based on SPX options. It uses two sets of options with more than 23 but less than 37 days to expiration. It's two sets of options, and you get the VIX. This value is calculated all the time. These are in trading hours and even after hours for a certain period. As long as there's SPX options available, you can calculate the VIX. The VIX is calculated from mid prices, from mid price between the bid and the ask, and that's how you get the VIX. It's a good gauge of fear, first of all, and also of volatility, how volatile the market's going to be over the next 30 days. But it's also an asset class. You can trade it if you think it's going to go higher. You can buy futures, you can buy calls, you can sell puts, and so this is how you trade VIX. Now on expiration day, which is Wednesdays, okay, you have a special value, a special opening quotation called VRO, and that's the one that's used to settle, to cash settled both futures and also options. Now we know which options are used to calculate the VIX, but what do we do with them? Well, we're going to look at this now. So you have the SPX. In this case, we have an SPX value right now of 3406, and you're going to have the in this case, I'm picking one of the expirations, and these are the options that are around the at the money. And then you have the out of the money puts and the out of the money calls. Of course, the out of the money calls are the ones with a strike that's higher than the at the money, and the out of the money puts are the ones that have strikes that are lower than the at the money. In this case, I haven't included all of them just because they don't fit on the screen, but you can see 3406, you have 3405 here, and this could be considered the at the money value. And then you go down in strike price and you get very, very small values here. And these are the strike prices that you have, okay? And same for the calls. With the puts, you go all the way down to 1500, 1450, 1400, etc. For the calls, you go all the way up to 4200, 4300, 4400. So now we're going to do, I've already mentioned that that to calculate the VIX, you use two sets of options, two different expirations, but in this case now we're going to go a little bit further and we're going to try to understand which particular options are used in this calculation. And even though we're not going to apply the formula can easily be obtained if you read the VIX white paper that's put out by the SIBO. Okay, so in this case, we're just going to understand which options are used in the calculation of the VIX. And remember, it's always two different expirations. Okay, in this case, I'm analyzing only one. So which options are going to be included in the calculation of the VIX? Well, we are going to include for this particular expiration, and we already talked about which expirations are going to be included, we're going to pick the at-the-money forward for both calls and puts. Now, in this case, don't pay too much attention to the at-the-money forward. Just think about it as at-the-money. Okay, so that's the strike where both the put and the call are the closest. Okay, so it's going to use both the call and the put for the at-the-money. Okay. Now it's also going to use all of the out-of-the-money puts with strikes higher than the first instance of two consecutive zero bid puts. Okay, so we're going to be reading all the different puts. Remember, there's a bunch of them here. I just didn't include them, but they go down in value until you have two consecutive zero bid puts. At that point, you stop and you don't consider those. And this is going to be the limit, your boundary for including those puts. Okay, so all of these puts are going to be included. Same with the calls. It's going to include the out-of-the-money calls with strikes that are lower than the first instance of two consecutive zero bid calls. Okay, same here. We're going higher in strike price, and we can see that we're going to reach a point at which we have two zero bid calls. At that point, you stop, you don't consider those, and then those are the ones you consider. And by the way, zero bid options from the set that we included for the calculation, if they're zero bid, they're not included in VIX in the calculation of the VIX. Okay, so if there's in between here a zero bid, that's not going to go into the calculation. Okay, so let's look at it visually. We're going to have SPX at 3406, so the at the money is 3405. So both calls and puts are going to go into the calculation. And then for the puts, we're going to find the two consecutive zero bid puts right here. So those are not included, and that's the limit. So we're going to include all the puts from 3400 down to 1400. Okay, remember 3405 is also included. And then for the calls, we're going to locate the first instance of two consecutive zero bid calls right here, and that's going to be the limit. So those are the calls that are going to go into the calculation. Okay. Now of course, you need, now that you have the options, now you know which ones to use, which expiration. Now you apply the formula, and the formula is the formula for a variance swap, trying to extract the variance from the value of those options by weighting those values and by performing a few mathematical operations. In this case, we're not going to concern ourselves with it. We're just going to understand that this is where the VIX value comes from. So now we know which options are going to be used in the calculation for the VIX, and we know that the formula is a formula that is going to be applied to these options, to the mid price of the bid and the ask, and it's similar to a variance swap. It's actually a variance swap. Get the variance, and then the square root of the variance is the volatility. So you get the volatility for that expiration. You get for two expirations. And after that, you do some interpolation to get the 30-day value that's going to be the VIX. Now, for this expiration, we have identified the limits by finding the two consecutive zero bid puts and plus including all the both puts and calls for the at the money. So now we have the range of options that are going to be used. The SPX options, including the VIX calculation at this time, are going to be the puts that are from the 1400 all the way to 3405, and the calls that are from the 3405 to 4200. Now, once you know which options you're going to be using, you just apply the formula and get the value for that expiration. You get the value for the other expiration, and now you have the value of the VIX, which is being disseminated all the time by the SIBO. Finally, we've already talked about the difference between VRO and VIX. VIX is a number that's always being calculated. As long as there's SPX options that you can get values from, you can get a value for the VIX. It uses two different expirations, and you get a value for the expected market volatility for the next 30 days. VRO is a settlement value. It's a number that's obtained only on expiration days, so only on Wednesdays, and it's at market open. It's a snapshot of the different values of the SPX options of a single expiration that is 30 days away, 30 days out. So they are very similar numbers, but they're not the same. And this is something that I wanted to make sure you understand, because, for example, what I've done here is I've included here both the values for VRO and for VIX. VIX are candlesticks, and VRO is only a single line. Okay, so as you can see, these are only Wednesdays because that's the only time that we have VRO. But you can see that those values are not necessarily the same. So for example, here, this is 29, and VIX was never in that area during that day. Same here. This was the VRO expiration, the VRO number, the VRO settlement value, and this is the VIX range, and it was never there. Same here, same here, same here, same here. If you look at the numbers over the last year, you can see that they're never the same, and for the most part, VRO is higher than the VIX. Now, why is this? Well, this is because even though they are related values, they're not necessarily the same, and they have significant differences, and those differences manifest themselves in very different values during that day. Remember, this is on a Wednesday, and this is the value that you could see of VIX. So for example, on this Wednesday, the VIX was between 35 and 38, and the VRO was like 43. So if you had futures that were expiring or options that were expiring, you don't care that the VIX was between 35 and 38. You care about the VRO only because that's going to be your settlement. Okay, so it's important to know this because most people might think that, okay, so it expired, let's see what the VIX is doing. No, it doesn't matter. What matters is the VRO, and the VRO, as you can see, I would say pretty consistently is higher than the VIX range for that same day. Remember, during the day, VIX uses two different expirations. For VRO, it's only one expiration, the one that's 30 days out. So what we're going to do here is we're going to go through the main differences between VRO and VIX. So the main differences between VIX and VRO are that VRO is calculated only at the open on expiration day, so on Wednesdays most times, and I include the most times caveat because if your standard SPX expiration that's 30 days out is a holiday and it gets moved ahead to a Thursday, then the VIX that's 30 days before that expiration, it's also going to be moved to the Tuesday, and then you're going to be able to trade it only until the Monday instead of expiring on a Wednesday and trading it only until the Tuesday. So it depends on the standard SPX options expiration that is 30 days out. So just as a comment, but for the most part, it's going to be Wednesdays. While the VIX is calculated constantly. So as I said, As long as there's SPX options available, you can get the VIX. VRO is calculated from actual opening prices, while VIX uses mid prices between the bid and the ask. Okay? Actual opening prices as opposed to mid prices. And why? Because the VIX is always getting a number, so it can't wait for a trade to happen, okay? So that's why it takes the bid and the ask and gets the average, and that's the mid price. The VIX ignores 0 bids in its calculation, while VRO uses the mid price for 0 bids if there was no trade for that strike at the open. So if there's a 0 bid, say for example there's an option that's 0 by a nickel, so 0 by 5 cents, bid ask, for VIX that's not going to go into the calculation. For VRO, it's going to, because there was no trade, there was no trading price. Remember, VRO prefers trading prices, but since there's no trading price, then it's going to take the mid price between the bid and the ask. So it's going to go as 2.5 cents. Okay, so that's a difference. VRO does not depend on 2 consecutive 0 bid strikes to determine the range of included options. Remember, we were looking at 2 consecutive 0 bids and then determining the range. That's for the VIX, not for VRO. The CBOE on expiration day at market open runs an algorithm that determines the range based on a proprietary algorithm. So we don't really know. CBOE makes it public, but beforehand, we don't know which options are going to be included in that calculation for VRO, which is the settlement price. So it's important to keep in mind this and to really understand this chart, this price chart, because you can see now if you always rely on VIX, okay, and you think that you have futures or options, and as long as, for example, you were short something and the VIX value is here and it was not in the money, well, the VRO, which is the actual number that you're going to be settled to, is a different number. So you always have to get the VRO, and as you can see here, I would say it's consistently higher than the VIX range, than the highest number or the highest value for the VIX on that day. So it's important to understand this so that you're not surprised if you have some futures or options that you take all the way to expiration and where you are going to go through cash settlement process.